Hello everyone, welcome to this Saturday educational presentation where today I'd like to talk to you about an easy way to trade tops and bottoms. Now we're all taught in the very beginning of our trading career that we're supposed to buy low and sell high. So we want to pick these tops and bottoms in a market because that will give us the highest level of consistency. For example, if we look at this chart here in FTNT, there are several tops and bottoms right here. What you want to do is sell right at this short-term top, and when it tops out and goes lower and bottoms out, you want to buy it back, and then when it goes higher, you want to sell again, right? This is the way trading tops and bottoms usually is, and it works fine for 2 or 3 trades, except when it doesn't work. For example, let's say after you sold right here, it didn't go down, it really didn't go up, but then started to drift a little higher. So you do what most traders do in this case, which is called doubling up. You'd sell again, hoping that it just has to go just a little bit lower in order to make some profit, but it doesn't go lower at all. In fact, it goes much higher. So now you're really faced with a dilemma. It's not going lower at all. You've pretty much given back everything you've made. You're basically breaking even, but you want to make that money back. All you want to do is really break even at this point. So what you do is what we call tripling up. You sell again, and this time you've really lost it all, and now you're really in the negative column. So this is the way most traders trade tops and bottoms. Well, the good news is I'm going to share with you a technique today. Well, you'll learn all of the beginning entry rules to this. And this technique, looking at the exact same chart, would not have taken any one of these signals, including the best one, which was the buy down here. But what it would have done was generate a buy signal here, another one here, here, and even here, so that potentially you could have captured 40 points. So this technique will really give you the edge you're looking for. So welcome to this educational presentation. My name is Steven Primo. I'm the president and founder of Specialist Trading. If you're new to my Saturday webinars, we're all about educating you as a trader, because our opinion at Specialist Trading is that the reason why most traders fail is because you take yourself out of the game. That means you're not making your own trading decisions. Now, do a little research. How do you actually make your trading decisions? Do you first go to a blog or to a chat room or a trading room? Or do you watch the guys on TV and find out what they like and what they don't like, or what they're saying about the market? Well, believe it or not, if you follow those things, you're basically giving your power away. You're letting someone or something else influence you to make your decisions. And see, in my opinion, after trading for over 4 decades, that's a recipe for disaster. In fact, that's the #1 reason why most traders fail, because you're giving your power away. So what we tend to do at Specialist Trading is just educate you. We never tell you what we think the market's going to do. We never tell you what we think a great stock is to buy or what a great stock is to sell. We never tell you what the perfect time frame is. Our job as educators is simply to provide you with these things that have stood the test of time, that have shown high levels of consistency, so that ultimately you can be educated and learn how to make your own trading decisions. In my 44 years of trading, from starting out on the floor of the Pacific Stock Exchange to teaching you right now, the only traders I know who are consistent, who have lasted that amount of times, are the ones who make their own trading decisions. So hopefully we can instill that concept and that philosophy in you today. Now, before we begin, as always, we're required by law to share this with you, so please take a moment to view our disclaimer. I'm going to share with you a lot of performance results using this particular entry technique, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Also, since we are an educational company, first and foremost, all examples are strictly for educational purposes only. Now remember, our goal is simply to educate you as traders. If you'd like to get more education on a daily basis, I invite each and every one of you, if you haven't done so already, to follow us on Twitter. I would suggest copying down our handle right there. It's abbreviation for Specialist Trading, because every day I post different information, anywhere from signals that our strategies have generated, and I go into detail why they were generated based on our concepts and our trading philosophy, to little bits of financial wisdom that I've accumulated along the way. So lots of great free trading education on a daily basis. Please feel free to follow us on Twitter. Now remember, we are first and foremost an educational company. We're not going to be telling you what we think the market's going to do next week or what a great stock is to buy or sell. That goes against all of our principles, all of our concepts. That's how most traders fail, by putting their faith and trust and relying solely on someone or something else to tell them what to do. Because if there's one thing I've learned over 44 years of trading, a good mentor does not trade for you. He teaches you how to trade. So that's our philosophy. That's our goal, simply to teach you how to trade with a specialist edge. It's the same edge that was taught to me some 44 years ago when I first started trading, and I struggled tremendously. I was lucky enough to have some mentors teach me the same things I teach my students around the world. So hopefully it'll be able to be instilled in you as well. Now, since this is a class, please ask me as many questions as possible. But once again, if you're new to my webinars, I like to take the questions at the end of the class. Many times, if you just wait for the next slide, your question will be answered. So please, if you have a question, just remember it or write it down. I promise I'll get to it at the end of today's presentation. The only question I will answer is this, and that is the most popular question, is this being recorded? Yes, it is. We record all of our webinars, so if you have to leave early or if you have any technical difficulties, oftentimes if you just log off and then log back on again, the difficulties will be remedied. But if you're still having technical issues, don't worry. Each and every one of you will be sent a link to this recording. Also, one of the best things about our recordings is that if you don't understand a concept, you didn't get a chance to write it down, don't worry. You'll be sent a link to the recording so you can study it at your own leisure, okay? All right, so remember, if you came in late and joined us late, please wait till the end to ask any questions. Now, I want to begin today's presentation by talking about, trading tops and bottoms. But remember, we've all been taught that to buy low and to sell high is really the way to go, right? That's where you're going to pick up some cheap prices in stocks or futures or commodities, and then you're going to sell them at the top. Well, in order to do that, you're really looking at overbought and oversold conditions. In other words, something is too high, something has gone up way too high too quickly. You always hear the pundits say, well, that's overbought. Or the opposite direction. If it's gone down too quickly, if it's gone down far too low, you'll hear someone say, or some indicator prompt you that it's oversold. So this is what trading tops and bottoms is based on, overbought and oversold markets. So let me share with you how most people trade overbought and oversold markets. Now, as we look at this chart here, once again in FTNT, the first thing most traders do is apply some type of overbought, oversold tool. Now, this can be an oscillator. It can be a moving average crossover. It can actually be something that you've purchased from another educator, or maybe something that you've put together yourself. Now, it really doesn't matter. All that matters is that it tells us something is overbought or oversold. Now, I'm going to use just a standard stochastic oscillator. I'm not changing or editing any of the inputs, so don't ask me what the settings are. I just clicked on stochastic oscillator, okay? So they're just the standard generic settings for a stochastic oscillator. Now, if you're ever looking at any type of overbought, oversold tool, usually you have some type of overbought and oversold threshold. For the stochastic oscillator, it's usually above 80, that red line on the top here. This tells us that things are overbought. So if the oscillator goes above that, it usually tells you the market is overbought. Now, if the oscillator goes below that, it's telling you the market is oversold, okay? So here's how we're all taught to trade these overbought, oversold markets. When we get into the so-called overbought area right here, and it starts to roll over or these lines cross, that's where you want to sell. And it works pretty well, right? Look at it, goes down. Now, you track the oscillator, whatever tool you're using, and when we get into the oversold area right here, that's where you want to buy back, cover your short position, and if you're privy to go long. Now you buy it, now you go long. And you've got a really nice trade here. So we're tracking the oscillator, and now it goes back into the overbought area. So we sell again. This is the way we're all taught. This is the way we all begin trading overbought, oversold markets, or tops and bottoms. And it works well until it doesn't. As you can see here, using this same format, we probably think we're going to retire in the next 6 months because it's just too easy, right? But what happens on the third time? Well, the oversold indicator, in this case the stochastic oscillator, doesn't get down to that level anymore. It just barely gets there, but then it pops up. Now this time you're thinking it's going to go back to oversold. It doesn't get there again, and now look what happens. We're right back into the overbought area. So what does this mean? Well, if you're more aggressive, you'll say, well, listen, it's not working this time, so I'll just double up and I'll sell some more. So let's say you sell some more right here, hoping it's going to go down, and it doesn't. It continues to stay in an overbought area, goes down for a little bit, and then once again gets in the overbought area. So if you have any more money left, you decide to sell some more, maybe purchase some more puts, and it goes down for about 2 days, and you think to yourself, wow, okay, this is finally, I'm going to make my money back. I just want to break even. And then what happens? Right back up again. Does that look familiar to anyone? Remember, it'll work great for about 2 or 3 times, and then most of the time you give it all back. I always tell my students, trading this style of trading, the conventional way to trade overbought, oversold markets, is very similar to going to Las Vegas or any type of gambling institution. If you play the slot machines, they are designed to give you a few winners because this gives you this false sense of security that you're doing all right. But really what they want to do is keep you there because you know if you continue to play the slot machines long enough, you'll give it all back eventually. And trading tops and bottoms this way has the same results. If you do this over time, eventually you'll give everything back. Look at your own trading if you trade this way. And I'm not saying this to be condescending or arrogant. When I first started trading on the floor of the Pacific Stock Exchange, that's where I started my trading career, I traded this way. And it would work great for a couple of times, maybe 2 or 3 times. I'd have some tremendous winners. And I'd say to myself, wow, this is too easy. I'm on my way to retiring here pretty soon. And then eventually the next 2 or 3 trades, I would give it all back and I would be back in the loss column. So it was tremendously frustrating when I traded this way, when I first started trading this way 4 decades ago, okay? And I was lucky enough to have some mentors on the floor who saw how much I was struggling, who saw how discouraging this was. And they taught me some amazing things that really were able to turn my concept and belief about tops and bottoms around. And this is what I want to instill in you today. This is one of the first things they shared with me. They said, Steve, there is no such thing as overbought or oversold. Now that goes against everything, entirely everything we've been taught. We're always taught that when something is too high, it's overbought. If something is too low, it's oversold. But they said that that's, a myth. It's an urban myth. There's no such thing. And it took me a while, I'll admit, it took me a while to grasp this concept. In fact, I didn't want to grasp it because I said, that's ridiculous, because I've had some great winners and some great, trades where I bought when things were oversold and I sold when things were overbought. But after a while, I continued to trade this way, and guess what? I gave it all back. And so ultimately I said, okay, I guess you're right. There is no such thing. And I went back and looked at a number of charts, and you can do this right now. Go back and look at whatever tool you're using, or whatever it can be, something that you devised or something that someone said in a blog, or maybe something that you're just looking at an indicator. If something is overbought, it can go as high as it wants to. How long have you seen a chart in any market, any time frame, just continue to go higher and higher and higher, and all the time it's been in the overbought column? Or, intraday, you can see these tremendous markets that fall out of bed, oversold, oversold, oversold. It just continues to go lower and lower and lower. So there really is no consistency in using this tool in the basic format the way most people are taught, myself included. So when I finally came around to grasping this concept, I said to my mentors, I said, okay, you're right. There is no such thing. Took me a while to admit it, but I said, you're right. So if there's no such thing as overbought or oversold, how do we trade tops and bottoms? How do we trade overbought and oversold conditions? Well, this is what they taught me, and I'm going to teach you this technique today. They said basically the right way to trade overbought and oversold markets is simply to go with them. And I thought to myself, what do you mean go with them? Well, that's the basic premise for this technique we're going to be sharing with you today. And you're going to get the entry rules to this technique. But please remember, I can't give away all of the rules. I'll explain that later on. But the basic entry rules is really all that matters, okay? Because that's basically highlighting a specific spot of entry. It's telling you a high probability point where the market is most likely going to be continuing in that direction. So let's look at this chart once again. All right, so the first thing you want to do is plot, or just at least be aware of some tool or indicator or method that is telling you the markets are overbought and oversold. And once again, we're just going to stick, for all intents and purposes, with the stochastic oscillator. It could be anything. It could be a moving average crossover. It could be an RSI. It could be something you've come up with. It could be what some guy says on TV. It makes no difference. You just want to exploit the overbought and oversold conditions, because we've come to the agreement now that there is no such thing as overbought or oversold. So something that's telling us that their market is currently overbought or oversold is what we're looking for. So remember, don't get stuck on thinking that it has to be the stochastics. It can be anything that tells you the market is overbought or oversold. In this case, once again, we're just using the standard stochastic. Don't ask me what the settings are. All I did was click on stochastic oscillator. All right. So the first thing they said to do is apply the 50-period simple moving average. Okay. Now, if you're looking at a daily chart, apply a 50-period simple moving average of the daily bars. If you're looking at a 5-minute chart, apply a 50-period simple moving average of 5-minute charts. If you're looking at weekly bars or monthly bars, the same applies. There is no need to complicate things by looking at 2 or more charts. All right, I know this is one of the most common questions I get from students saying, well, Steve, does this mean I plot the 50 of let's say, a weekly chart as well as a daily chart? You can if you want to, but why overcomplicate things? If you're taking signals based on daily bars, that's the only chart you need to look at. There's no reason to look at different multiple time frames. I know that's always taught, but once again, that, in my opinion, is an urban myth. I have never seen any consistency in 4 decades of using 2 different time frames. All right, so if you want to, feel free to do that, but it's not taught here. If you're taking signals on a 5-minute chart, that's the only chart you need to look at. If you're taking signals on a weekly chart, that's the only chart you need to look at. Now, in this case, in FTNT, we're looking at a daily time frame. So we apply a 50-period moving average to the daily bars. Now that we've plotted it, we ask ourselves this question: where is price in relation to the 50-period simple moving average? And you may want to copy that down and post it on your computer because it's extremely important. Where is price in relation to the 50-period simple moving average? Now, obviously, price is above. So if price is above that moving average, that means we will only be buyers. We will never be selling above the 50. And conversely, if price would have been below, we would have been sellers. But it's not, so it's above. So what does this mean? We're not going to take any sell signals. We're only going to take buy signals, okay? Now, how are we going to base these buy signals off of? What are they going to be based off of? Well, remember, there is no such thing as overbought. So we're going to exploit overbought conditions. So this brings us to the next step. We want to locate and identify these so-called overbought areas, which are right here, okay? Because we're using the stochastics, we can identify them on the chart. So everything circled in red is where we went into so-called overbought area, right? But we know that doesn't exist. So we're just going to exploit it. So now the next step is we want to identify pivot highs that were created and generated in this so-called overbought areas, okay? So if you're not familiar with what a pivot high is, it's simply a 3-bar pattern. All right, bar number 1 makes a high, as you see right here. Bar number 2 makes a higher high. Bar number 3 makes a lower high. So you have this kind of an arrowhead overall approach here. So you're looking for this 3-bar pattern in a so-called overbought area. And as we see here, here's one right here. You have a high, a higher high, and a lower high. And that's right in the so-called area. So as we look, we place these green horizontal bars all at the point where these 3-bar pivot highs were made. Now, obviously, there were some others made, like one was made right here, but it wasn't in the overbought area. We're only concerned with the overbought, so-called overbought areas, which takes us to the next step. We're going to buy when price trades above these pivot highs, okay? Doesn't have to close above, just has to trade there. So every time we traded above there, we would simply be buying. As you can see, if we extend the line out, that was our buy, here was another one, and another one. So instead of having all these sell orders where we continue to lose money, we're only going to take buys, and potentially, had we taken this very first one here, or maybe this one here, we could have potentially made 40 points coming into the end of March last month. Now, where we traded the exact same stock using the exact same indicator, the stochastics, but in the traditional sense, which holds no level of consistency, we would have lost most likely everything. But here, we potentially could have made 40 points. Now, remember, I'll tell you some ways at the end of today's presentation where you can learn how to sell and how to place a stop and how to track the trade and how to apply money management. But for now, we're just teaching you how to identify these high probability setups. All right, now this works to the downside as well. We're looking at letter V here. I believe this is Visa. Okay, So remember, most people would look at this and say, well, Steve, it's directionless market. I don't have any idea what it's doing. But what's the first thing we do? We add the 50-period simple moving average. And once we apply it, we see that, well, originally we were above, then we're below, then we're above, then we're below, okay? But for the last week or two, we have been below. So if we ask ourselves, where is price in relation to the 50-period simple moving average, we're asking about the short-term trend, the last week or two. And as you can see, we've been below. So what is that telling us? It's telling us that the overall trend is down, and if we're going to be doing anything, we want to be looking at it from a seller's point of view. We're not even going to consider any buy signals. Why? Because the odds are in your favor if you only sell when price is below the 50-period moving average. All right, so since we're going to be looking at things from a seller's perspective, this means we are going to be exploiting the so-called oversold areas, okay? Because remember, we know there is no such thing as oversold. Stocks, futures, currency pairs, commodities, they can go as low as they want to. So there's no reason to think anything is ever overbought or, in this case, oversold. Now, just a point of fact here, people always get confused at this chart. They say, well, Steve, we're originally above, then we're below, then we're above, below. So how would I know what to do here? Remember, when we were above, the only way you would have been able to buy is to by adding the structure of exploiting overbought areas. So were we overbought here? No, we never went overbought. And then when we went below, did we ever go oversold? No, we didn't. So there's no setup to worry about. Then when we went above here again, did we really go overbought? Not really. We peaked up above for a little bit, but then came right back down. But here, now that we are below the 50 once again, now we have clear indication that we were in the so-called oversold area. So we can exploit this. So what's the next step? We want to identify pivot lows that were generated in this so-called oversold area. Now, a pivot low is the exact opposite of a pivot high. It's a 3-bar pattern where you make a low, followed by a lower low, and then a higher low. And you create this kind of a V approach right here. So we're looking for this 3-bar pattern in the so-called oversold area. So here's the oversold area right here. And here's that 3-bar pattern. We make a low, followed by a lower low, and a higher low. So this means that we can sell when price trades below the pivot low, which is bar 2, right here. All right, so we extend that out. As long as we're below the 50, we just wait for it to trade there, and it traded there right here. Even though it didn't close there, that's okay. You trade there, and nice quick little 17 points in about a week. Nice little trade, right? Now, what happened to the oversold? If we were oversold here, I must imagine that we're really oversold here, right? Remember, you must grasp this concept. There is no such thing as overbought or oversold. Stocks can continue to go much lower and lower and lower, and all the while they're in the oversold column. Or they continue to go higher and higher and higher, and all the time they're in the overbought column. For the past year or so, we've been going up. And the markets have been overbought, the entire time. And we continue to go higher and higher. So it's just silly to believe in this concept. There's absolutely no consistency in trading it overbought and oversold in the traditional sense. You must twist it around and exploit it. All right, so let's look at some more current examples. Examples that may have started 6 months ago but ended last month or even this month in April, okay? Here's an example in TPR. All right, now obviously, where are we in relation to the 50 period? We are above. So we're only going to be a buyer. Now look at all of these so-called overbought areas right here, okay? Once we asked ourselves where we were in relation to the 50-period moving average, if we were overbought here, boy, I imagine we're really overbought here, and then we're really overbought here, and then going back into middle to the end of March, we must be really overbought. You see how it's just an urban myth to believe in overbought and oversold conditions? So we're going to exploit these and identify all the 3-bar pattern. In this case, the pivot highs, which are identified right here, and we could have bought and potentially made 20 points if we took the very first setup. Now, I always tell my students, the very first setup is the one that holds the highest potential, because if it really takes off, that's the one you wanted to buy on. But obviously, if you would have purchased this one, if you would have missed these first two, you could have potentially made about 10 or so points. There's always room for it to move. And remember, we're not talking about where you'd exit today. We're not talking about where you'd place your stop. I know a lot of you are going to say, well, Steve, you would have been stopped out. Where would you exit? That's all discussed and covered in our courses. All right, here's an example in TTWO. Now, originally, we were above. We had a 3-bar pattern here, high, high, high. And this is where students make mistakes. They say, well, Steve, I bought it. It went up for 2 bars, and now look at it, I'm getting killed. Well, in order to buy it, this 3-bar pattern has to be in the so-called overbought area because you're above the 50 and you want to exploit overbought conditions. So if we go straight down, was the stochastic oscillator ever in the overbought area? No. So you would not have had any setup to take. You see, this is why you must be very diligent and follow the rules, and you must study and research, because most students fail a lot of times simply because they didn't learn the rules and apply them correctly. So now at this point right here, coming into March, we see that we started to have consecutive closes below the 50. So the market is telling us it wants to go lower. So if that's the case, we're only going to be a seller, and we're going to exploit the oversold areas, which are right here. Now, if we exploit those areas right here, we want to identify the 3-bar pattern, the short-term lows. We see one right here, which would have potentially made 30 points coming into mid to end of March, all right? And as you can see, there was one more right here, and I don't know if that one ever got filled, because that was just about 3 weeks ago, but that would have been a nice 30 points potentially you could have made, right? Here's another example in MHK Mohawk, all right? Price is obviously going up. It's above the 50. Now, you knew well in advance, way back here when the stock was trading at about 105, that it wanted to go higher. Not because of the earnings, not because of some guy on TV or some guy in a chat room. You knew because the price was above the 50. You see how easy it is when you make your own decisions? You don't have to rely on anyone or anybody else telling you what the market's going to do. The market itself, the chart in front of you, was telling you it wanted to go higher. So if it wants to go higher by being above the 50, you don't want to go against the grain. You don't want to swim upstream. You want to swim with the current at your back. So one of the great things to do is add some structure in the terms of exploiting the so-called overbought areas, which are right here. And had you looked for that 3-bar pattern and taken this very first setup, well, potentially you could have made 60 points if you held the entire time coming into April. As we look at REGN, all right, once again, price was originally above the 50. Once it crossed below, what's the market telling us? Well, it was telling us in mid-February it wanted to go lower. So who are we to say, nope, the market has bottomed out. No, we're oversold. And it's silly. Your job as a trader is simply to listen to the market, find out what it wants to do, and then jump on board. Just go with it. You should never try to outguess what the market's going to do. Say it topped out, or it will stop here, or this is a good buying range right here. No one knows that. Why not just listen to the market and go with it? And the market right here was telling us it wanted to go lower. So in that case, we're going to use this technique and exploit the so-called oversold areas. We identified 2 of these pivots, one here and another one here, and potentially you could have captured 55 points to the downside coming into March. Here's an example in Expedia, okay? Price is above. Now someone could say, well, Steve, but price went below right here, and it was below right here. So why didn't we sell? Well, first of all, it never went below the pivot low, as you see right here. And secondly, it never was in the oversold area. Remember, you're only going to look for these when you're in a so-called oversold area. Now here we were oversold, but look where price was. Price was above the 50. Remember, price needs to be below the 50 in order to exploit oversold. So since the majority of price is above the 50, we're going to exploit the overbought areas. Now look how overbought this was right here, okay? This was in October. The price was trading at 105, okay? How well did that work? Look where the price is now, 185. 80 points higher coming to the middle to end of March. And it continues to flash overbought areas, all right? We're going to exploit them. Look for that 3-bar pattern. And as you can see, had you taken the very first one right here in November, had you held on coming into the mid to end of March, you could have potentially had 80 points. Here's another example in EQIX, okay? Once again, we crossed below the 50-period moving average in mid-February, so we knew it wanted to go lower. All we need to do is identify the oversold areas, so-called oversold areas, and then locate where these 3-bar pivot points are. One right here, another one here. Had you taken the first one, 95 points coming into mid-March. All right, let's go over the process just so that you fully understand it. Let's look at a blank chart here in DEER, DE. This is going back about 9 months, okay, going back to May or June. Now, as we look at this here, okay, in hindsight, obviously, you would have wished you were a buyer, all right, at the beginning in June, roughly when the stock was trading at about 120, 130. But how could we have known that? Well, there are ways to actually have been able to trade this. The first thing you want to do, the very first thing, is to apply any overbought or oversold tool. Remember, this can be something you've created. It can be any type of oscillator. It can be any type of moving average, crossover, anything, even some guy in a chat room. It just needs to tell you, whatever you're listening to, that the market is overbought or the market is oversold. And the reason is because we know there's no such thing as that. So we're going to exploit it. So we need someone to tell us that it's overbought. We go, great, thank you. That's my perfect scenario for exploiting the market. So we're just once again going to apply a standard stochastic oscillator. I don't know what the settings are, so don't ask me. Just whatever platform you're using, just click on stochastic oscillator. All right. Now, if you're above that top threshold, most likely it's telling you you're overbought. If you're below, it's telling you you're oversold. Now, the second thing we want to do is apply the 50-period simple moving average, because this tells us if we're going to be a buyer or a seller. So once we apply the 50, we know going all the way back to May and June that we were above the 50. So there was no reason to play the game that most traders play, and that I'm a victim. Gosh, I wish I would have known this was going to go up. You knew, looking at this simple tool, that price was above the 50. So there was no one that you needed to listen to, or no blog you needed to read, or no chat room you needed to attend. You just had to apply the 50 and say, well, I should be a buyer of this stock. I don't know how yet, but I'm going to apply some structure because it's telling me it wants to go higher. Until it has consecutive closes below the 50, I know I want to be a buyer in this. See how simple that is? So now let's add some structure. We're going to exploit the so-called overbought, oversold areas. So we want to ask ourselves, firstly, where is price? Price is obviously above, so we're going to be a buyer. Now, we want to locate all of the so-called overbought, in this case, the overbought areas. Why? Because we're above the 50. And here's where they are. We're overbought everywhere we went above that threshold, and we circled it in green. Look at how many times this stock has gone straight up from June all the way up until last month. And look at how many times it was overbought. Okay? Isn't that silly? Do you see how there is no such thing as overbought or oversold? It's just a silly way to trade this. It's just, once again, it's an urban myth. I remember my mentors taught me, they said, Steve, there are so many things there are that aren't. Meaning that there are so many fake things we use that are supposed to work that really don't work. But for some reason, they've just caught on, and we just use them because we think it's supposed to be. That's traditional, so we continue to use it. But there's no consistency in them. So we're never going to use overbought and oversold conditions in the traditional sense. So what we want to do now is go to the next step, which is identify these pivot highs that were generated in the so-called overbought areas. Remember, a pivot high is just a 3-bar pattern. Bar number 1 makes a high. Bar number 2 makes a higher high, and bar number 3 makes a lower high. So you have this type of arrowhead approach here. So these are all the areas, these little small horizontal green bars, where a pivot high was created in a so-called overbought area. And now we go to the fourth and final step, which is to buy when price trades above the pivot high. That's it. Okay, as long as price is above the 50, you can buy once we trade above, and it doesn't have to close there, it just has to trade there, okay? Now, had we taken the very first one back here in May or June, potentially we could have captured 230 points if we decided to stay in. Now, I can tell you right off the bat, I wouldn't have stayed in for that long, but who knows? Remember, you're in charge of your own trading. We will never tell you where to exit. We'll never tell you where to buy. We'll never tell you where to place a stop. But what we will do is provide you with upwards of 6 or 7 different entries, stops, and exit points for each setup. So you can decide which one you like best and which one fits your persona. We will give you the information, but you must ultimately decide. I mean, think of it. Most traders always look for someone or something else to tell them what to do. I mean, I can tell you 50% of the time when I give a webinar, even though I say this over and over again, one of the most common questions I get is, well, Steve, where would you place your stop? We're all trained for someone to tell us what to do. And that would be similar to flying in an airplane and having the airline pilot say, hey, listen, how do you think I should land this? Or how do you think I should, if I were a brain surgeon, how do you think I should operate? I mean, you would think that's ridiculous, right? But traders do this every day. We wait to see what someone's going to say on TV. We go to a trading room to find out what they like, what they're doing. We go to a webinar to find out what some guy's going to tell us what to buy or sell next week. I mean, that's silly. You should be in charge the same way an airline pilot, the same way a brain surgeon is in charge and knows exactly what to do. That's the way you should approach trading as well. Now, I know not everyone just trades daily bars of stock. So let's look at some other time frames. Let's look at some other markets, okay? Same concept applies here on a weekly chart of AMAT. We're above the 50-period moving average. This is going back to October. So this is telling us we're buyers. If we're a buyer, we're going to exploit the so-called overbought areas. And so we just identify that 3-bar pattern right here. We could have gone long in January and potentially captured 50 points on a weekly time frame. You see, nothing changes because we changed the time frame. Right? You can apply this to 5-minute bars if you want. You can apply it to monthly bars. You can also apply it to different market. Here's a minute chart, I should say a 60-minute chart of the euro dollar for all you currency pair traders here. All right. Going back, this was at the end of March, just about a couple of weeks ago. We're below the 50-period moving average. So for you currency pair traders that said, wow, I didn't know the euro dollar was going to go down so low. Well, yes, you did. I mean, if you learn how to listen to the market, it's simple. If we're below the 50, it's telling you, I want to go lower. So if you know it's going to go lower, look for this 3-bar pattern, exploit the so-called oversold area. You see how oversold we were, and we just kept getting oversold, more oversold, and the euro dollar just kept going lower and lower and lower. And if you use this technique to the downside, sold every time you went below that 3-bar pattern, well, if you take in the very first setup here, that's 150 pips in just about a week. That's about $1,500 per unit. And then lastly, for E-mini traders, here's a 30-minute chart of the E-mini futures. All right, this is going to, this was just a little over a week ago, the first day of April. Same thing applies. We're now above the 50 period on a 30-minute time frame. We crossed above. All right, this was the last day of March. So we now know that we're going to be a buyer way back here because we have consecutive closes above. So we wait for the so-called overbought, oversold tool to go into the overbought area. We look for that 3-bar pivot, and had we taken this very first setup and held, potentially we could have made 40 points in just about 24 hours. That's roughly $2,000 per contract. Once again, I'm not saying you would have made 40 points, but that's how much you had to work with. Okay? So wouldn't you like to know in certain instances you had that much to work with? Maybe you only wanted to take 10 points out of it. Maybe you wanted to take 30 points, but ultimately it would have been your decision, not ours. Okay, so let's recap before we tell you about a great offer we have for all of you. Remember, as my mentors taught me, this was a hard concept to grasp, but you will really take your trading to the next level once you grasp this concept. And that is, there is no such thing as overbought or oversold. And don't just take my word for it. Go back and do the research. Look at whatever markets you've been trading. Go back and look at the markets this past year. Stocks will go up as high as they want to or as low as they want to. And all the time they will be in the so-called overbought area or oversold area. It's just a silly concept to hold on to. Because remember, it's just like the slot machines in Las Vegas. If you stick around long enough using this, you will ultimately give everything back, just like the slot machines. They're designed that way. So why would you trade this if there's really no level of consistency? So if there's no such thing as an overbought, oversold, then what's the answer? The answer is never, ever try to pick tops and bottoms. There is really no consistency in that method at all. So I have a homework assignment for you. It's an easy one, but based on what I just taught you, take a look at some of your last trades. Okay, it could be the last 2 or 3, it could be the last 10 or 20, it makes no difference, but apply this technique I just shared with you. Ask yourself if you could have improved your trading results. I think your answers will be a resounding yes. If you haven't done so already, I know many of you are listening to this webinar and looking at charts and saying, wow, this stuff really does have an edge to it. maybe I should have been using this all along. Well, if you really feel that it could help you, there are points to remember though, because remember, this is not a complete strategy. All I did was share with you a pinpoint or a spotlight of a high probability setup. In order to have a full-fledged strategy, we need to talk about exact entry points, all right? I just gave you a basic concept of buying once we trade above that pivot high or selling once we trade below, but we really didn't pinpoint it. We also have to talk about stop placement. You know, I'm not going to sit here and tell you that every one of these setups works 100% of the time. Sometimes you have some small losses. So you have to protect yourself. We didn't talk at all about protecting yourself with a stop placement. You also have to have advanced exit signals. Now, some of these examples had 20 points, 40 points, 200-point potential profit. But where would you have exited? Would you have held on that time, all that time? How would you have known? You need to know where to get out. And then lastly, we have to talk about money management. Whenever you're trading a full-fledged method, a full-fledged strategy, you have to talk about money management. How many shares? How many contracts? Would you track the trade? Would you exit a portion of your position and hold on to the rest? This is all sound fundamental money management, which we didn't bring up at all. So in order to trade, you need to also apply these things. Now, I want to talk to you about a great Saturday morning attendee discount. We're going to offer you actually two different strategies. The first one is strategy number 1. This is a pullback method, okay? Now this pullback method is designed to buy lower and sell higher. It goes against what we've been talking about. Uses completely different parameters, completely different ways to trade, all right? We're going to give you the complete rules for entries, exits, and stops. We're also going to share with you an aggressive plus a conservative version. It uses a unique setting using a really great indicator, and these are the Donchian channel settings. Now, let me share with you just an example of how this works. Here's an older chart in Netflix. Now, most people would look at this and say, well, Steve, you know, I took that $10,000 class on candlesticks. And what do we have right here? We have an evening star, which is a bearish pattern. We also have a bearish engulfing pattern. So two bearish candlestick patterns. So I'm going to say that we are in a downtrend. After all, you're always saying to make your own decisions, right? Well, that's my decision. Well, it isn't just enough to make your decision. It has to be based on consistency. Because strategy number 1 is our most consistent pullback method. And a pullback method is designed to buy at lower levels in an overall uptrend. So where you would have thought we were in a downtrend based on these candlestick patterns, guess what? Strategy number 1 generated a buy signal. And in 2 days, the stock went up 40 points. So this is completely different. Strategy number 1 is designed to buy lower, also generate sell signals at a higher level as well. It's different from the technique I shared with you. But we're not going to stop there. We're going to throw in a completely different course based on completely different rules. This is strategy 3A. This is our continuation method. Now, a continuation method is different. It's very similar to the method I shared with you today, the technique, where you're looking for an established trend and then you're waiting for some type of pause and then jumping on board. It does this by using a unique Bollinger Band setting. And we're going to give you a proprietary entry technique, proprietary exits, as well as stop placement as well. You're going to get all the complete entry, exit, and stop placement. The beauty of this is, even though it says E-mini, you can apply this to any market, any time frame, in any direction. When I first started teaching this method, it was because there was a lot of, or there was a lack of, I should say, volatility in the market. So this continuation method worked best in intraday trading of the E-mini. But because of the increased volatility through the years of all markets, you can apply it to anything. We have currency pair traders trading this. We have Bitcoin traders. We also have stock traders as well. Let me share with you an example here. Someone looking at this older chart in Boeing would say, well, Steve, we're in an uptrend. I wanted to buy this. You're right. I think it's a good buy. But you know what? I kind of missed it. It got away from me. And now we're in the so-called overbought area. So I'm a little bit scared to do this. So I don't think I'm going to take this trade. Well, strategy 3A generated a buy here. Now remember, it's not based on that 3-bar pattern. It just would have generated just off this bar right here, generated a pattern, a buy pattern, and the stock went up 80 points. So this is completely different from strategy number 1, completely different from the technique I gave you. And so you have all those 3 things in today's offer, but we're not going to stop there. We're also going to throw in some extra bonuses. In fact, a total of 7 Saturday morning bonuses. The first one, you're going to get the add-ons for your platform. Let's say you have TradeStation or Metastock or NinjaTrader. You'll get the add-ons that create the up and down arrows when the signals have been generated. Bonus number 2, you're going to get our 3-hour video seminar. That's the secrets of a stock exchange specialist. I spoke at a conference in Denver years ago, and they recorded it, and this is a great way to learn many more edges and techniques. Bonus number 3, you'll get the PDF version of my book. I go into detail, almost on a trade-by-trade account of what it was like to trade during the crash of '87 on the market, on the floor of the stock exchange. So during that market environment, it was crazy. It would be comparable to the market being down roughly about 7,000 points in one day. So you get a really great account of what it was like to be on the trading floor. Bonus number 4, probably I think the best of all these, you're going to get 6 months of our PTS Primo charting platform access, totally free. Along with that comes bonus number 5, that's the Secrets 2.0 course, where we take your trading up a notch with many more advanced trading levels and trading different ideas. Bonus number 6 and 7 are very similar in that you get scanners on our platform. You can either individually scan for these individual strategy signals or have a multi-scanner for both strategies as well as other techniques and other things we have on the platform all at one time. So this is a great, great offer. We're throwing all of this in for your attendance today. So let's break this down, our Saturday morning discount. If you purchased all these separately, the 2 courses, 6 months of the platform, along with the 7 bonuses, it would normally cost you over $4,400. But because you've taken the time out, and because this is a great offer, we want to really show you how sincere we are in trying to educate you as traders. By giving you upwards of 4 decades of information I've accumulated, we're going to discount it down to less than $300, $297 altogether. You're going to have a savings over $4,100. Remember, that's 2 full-fledged strategies with all the entries, exits, and stop placements. You're also going to get 6 months of our platform. You're also going to get all the 7 bonuses with the scanning capabilities and a PDF version of my book, along with a 3-hour recording, excuse me, of the Secrets course. So many things along with things available on our chart. You have roughly 4 decades of experience and knowledge that I've accumulated 1 click away on the platform. For less than $300, I can't think of a better deal and better way to get acquainted with us if you haven't become a student of mine yet. So take advantage of this great offer because, as I always say, a year from today, you will have wished you became a member of these courses. If you keep doing the same thing you're doing and not getting the results you were promised, trust me, a year from now, most likely this price won't just be $4,400. It'll most likely be closer to $5,000 or $6,000. Take advantage of less than $300. You owe it to yourself to take your trading to the next level. Here's how to do this. Contact Pro Trader Strategies. They're my sister site. They developed all the course material with me. They also are in charge of all the discounts. They're also in charge of all the tech support with the platform. So any questions you have concerning the platform, they're the ones to contact. But they're great. They have trading consultants manning the phones right now. They would be more than happy to take your order over the phone if you'd like. Or if you had questions about the platform, they'd be more than happy to answer any questions you have as well. I would really seriously think about calling them at 310-598-6677. Once again, they can answer any question. There's absolutely no obligation. They would be more than happy to answer any question you have. Now, that link you see at the very bottom is the link that will take you to the information page as well. If you'd like to sign up online, you can do that there as well. But I always, suggest that if you have questions or if you want to just, talk to someone, person to person, give them a call. It would be much better. And remember, there's absolutely no obligation. They're there to work with you. They're very flexible, and they'd be more than happy to answer any questions concerning pricing and tech support. Now, I promised you I would answer questions concerning trading and what I taught you today. So once again, if you do have any questions, just go to your question and answer box, type them in, and I will be happy to answer them. Okay. Hello to everyone there. So I see a lot of people saying hello on this Saturday morning. Hello back. Someone is asking, what on your promo page you said educational correspondence. What is that? Educational correspondence is simply you get the my personal email address. So if you ever have any questions, if you ever something doesn't make sense, or you just want me to check your work, this is how you contact me. I know a lot of websites, a lot of so-called educators will share with you, a booklet, or they will give you some type of, a link to a recording, and that's the last you hear of them. But that's not what we do here. What we do here is, remember, we're educators. We're really trying to educate you. So if you ever have a question concerning the trading, concerning these strategies, or the things, how to trade with them on the platform, or even, like I said, just check your work. You will get my personal email address, and you can contact me whenever you'd like. I'm going to be, after I finish this, actually, I'm going to be answering some emails from questions of students that sent me this weekend. So I even answer questions over the weekend, okay? Someone's asking, can you have access for 6 months of the platform after we are done learning your techniques? Well, after 6 months, there's most likely going to be a price for it, but I know Pro Trader Strategies is very, they're very easy to work with, and they're very flexible. Because you are now a student of our courses, I'm sure you won't have to be charged an arm and a leg with an exuberant price. So they would be very happy to work with you on that. I know the standard price is roughly about, I believe it's $97 a month. So that's even less expensive than other platforms. I know there are some other platforms, I won't mention any names, that are charging anywhere from $300 to $400 a month. And they don't give you half of the things that we have on our platform. I always tell students that not only are you going to get the same tools and indicators that you find on other platforms, but you're going to get things that you have never found or heard anywhere, because there are things that I have taken from my experience on the floor, things that we have put together ourselves, and this is where you'll only get it on the PTS Primo charting platform. And for less than $100 a month, that is a great, great offer. But remember, you won't even have to consider that until 6 months from now. So that's entirely up to you. All I can tell you is that the majority of our students come back with us because they're so impressed, and they use the tools and they really help them. I know a student who really, just kind of go off on a tangent here, but this trader was a totally fundamental trader. In other words, based all of his information, listening to earnings, listening to the guys on TV say what they think about the CEO or where the stock direction is going. And I just offered him, a chance to work with our platform. And he took a trial, and one of these 6 months trials, and he is hooked on it now. In fact, he can't get enough of it. Now, he still uses his own method for applying fundamental news along with our platform information, but it makes a really nice combination, and it's for the very first time he's used our tools. He says, I really feel like I'm rounded out and based and balanced because I'm getting the best of both worlds. So it makes no difference what you traded in the past or how you've based your decisions in the past. What matters is the information you get here you won't find anywhere else, okay? Someone is asking about selling options. Well, first of all, remember, we're not an option course. We're just sharing with you high probability ways to trade. Now, if you decide to apply options, that's entirely up to you. Now, if you contact Pro Trader Strategies, I know they do sell some option courses. I would contact them, though. That's more on their website. But personally, I don't go into actually how to trade options, nor do I go into how to trade E-minis or how to trade Bitcoin. Our job as an educator is showing you techniques and methods that can be applied to any market or any type of tradable unit. And then it's your decision as to how you want to apply it. So in other words, if I share with you a high probability setup that can be applied to any market, how you want to trade it is up to you. If you want to actually buy the stock, if you want to apply it to futures, if you want to use it to write options, it's your choice. But it would be comparable to someone teaching you how to play golf, okay? I can teach you how to play golf and teach you how to move in your swing and the stance and how to hold the club. But which clubs to use, that's up to you. I'm not going to decide for you or which golf course to play at. That's your decision. It's the same way with teaching. We can show you the way, but ultimately you've got to make the decision on how you apply it. Okay, great questions. If there are no further ones, I just want to say I hope you learned a little bit today. If you've attended other webinars by other so-called educators in the past, you'll know, because I've attended them myself, that most of them are just really kind of geared towards selling you something, where they just basically tease you along the way. And in order to know how to apply it or use it, you've got to spend $5,000 or $10,000 to purchase a program or an indicator, right? I know, because I've been there before myself. But we always like to show you our sincerity to really wanting to teach you. And so even if you don't decide to become a member of this great offer today, we taught you something today that you can actually use as early as Monday. The technique for finding these runaway markets, for trading the right way to trade tops and bottoms, is yet now yours. You now know how to apply it. So we always want to give you something just to show you our sincerity that we really want to elevate your trading. So if you're convinced that we're here to help you, come on board with this great offer. Remember, less than $300. I can almost guarantee that the majority of you, we had about 50 of you in the course today, I can almost guarantee the majority of you lost over 300 this past month, just trying to make sense out of the markets. Take your trading to the next level. Elevate your trading. Take advantage of this really inexpensive offer, because most likely it'll be back over 4,000 in the next couple of weeks. It's for a limited time only. As you take one last look at our disclaimer, I just want to say thank you so much for attending today. I really wish you the best of luck, but mostly I look forward to all of you becoming students of mine at Specialist Trading. Thank you so much. Have a great weekend. Hope to see you next time. Bye-bye.